Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, June 23rd, and I'm recording from our studio in Purchase, New York. Approaching the mid-year point, most investors might be looking at recent equity index resilience as an invitation to add to the S&P 500. We would resist the urge, however, noting that recent market action may have swamped the real story, which is that year-to-date, bonds are actually beating stocks. While the S&P 500 is up about 1.5% this year, treasuries are up 2.8%, investment-grade bonds are up 2.9%, and high-yield bonds are up 3.4%. We find this both surprising and encouraging, given all the headwinds that have been faced by fixed income market this year. From disappointments about Fed policy to inflation fears and mounting concerns about America's debts and deficits. Overall, our read is that these are healthy developments, with normalization of rates and term premiums reflecting a final chapter of healing from the dual crises since 2009. It is also a recognition not only that neutral rates are higher, but that extraordinary policy intervention by the Fed is no longer needed. Perhaps more importantly, despite our call for equities to grind out another 5 to 10%, we see bonds continuing to deliver and do their job. Here's why. First, consider relative valuations. Bonds are currently priced to provide positive after-inflation gains, with yields on treasuries averaging over 4%. Investment-grade corporates are paying more than 5%, and high yield more than 7%. These are superior to how the S&P 500 is priced today. The equity risk premiums remain at 20-year lows, again near zero, which is staggering given the risk backdrop around domestic policy and geopolitical uncertainty. Next, we see bonds more easily benefiting from shifting policy. While eventual Fed rate cuts are obvious tailwinds, it is heartening that the yield curve is not priced aggressively. While Fed funds futures suggest 4 to 5 rate cuts by the end of 2026, the 2-year Treasury has been discounting just about 1 cut. In addition, deregulation may also bode well for the short to intermediate end of the curve. Bank capital requirements may be loosened, which could allow banks to increase their Treasury holdings without impacting capital charges. This is important as Treasury issuance is poised to accelerate, with more than a third scheduled for the front end. What's more, proposed legislation on stablecoins could also stimulate short-duration Treasury demand. Finally, we think investor hand-wringing over the stock-bond correlations and the loss of diversification properties for bonds may be overblown. Risks around diversification are actually concentrated at the long end. Consider that equity return correlation with the 30-year has been rising and is meaningfully positive, while the correlation with the 2-year yield remains strongly negative. In other words, diversification benefits are only a constraint when investors extend duration. Staying below benchmark duration, as we recommend, could still provide volatility buffers. So overall, now is not the time to abandon your fixed income allocations. Patience and coupons may be best rewarded. Consider staying overweight in short to neutral duration investment grade and municipal bonds. Position your portfolios for a backdrop of average 5 to 10% U.S. equity returns in an environment that's more volatile, has higher real rates, and a weaker U.S. dollar. Also consider adding diversifying positions in international equities, commodities, energy infrastructure, and hedge funds. As always, thank you for listening. And for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.